we've had pullbacks. I think Dan was alluding to it. We've had, this sort of rolling correction go through the market. It was the high price stocks earlier in the year. Then it was SPACs. And, now they're getting into the reopening and sort of recovery stocks as, perhaps, people are worried that maybe the peak rate of change is in. This is all part of the same narrative, which is, after you reach the peak rate of change on growth and policy, the market always goes through what we call mid-cycle transition. And during that transition, the market is searching for the next leadership group, and it's confused. It doesn't really know, what it wants to bet on. Should inflation be transitory? Did the Fed stop that? Are we going to have a growth slowdown that's more meaningful in the back half of the year? All those factors, I think, are weighing on sort of these rotations that we're seeing in the marketplace. So here's how we think it plays out. Number one, we think that peak liquidity already happened. That happened in February, March with peak rate of change on M2, M1 growth. That's what hit the high price stocks and some of the speculative areas, and that's continued. And we think that's probably a good thing, meaning some of the speculative assets are no longer trading at ridiculous multiples. Some still are, but we're taking some of the air out of the balloon there. Now, as we go through the transition into the second half of this year, we think one thing that's being underestimated, the Delta variant is important for international markets, as Karen said, but for the U.S., it's not a big deal. I think the bigger deal for the U.S. market and economy is the fiscal cliff that we're going to experience because the stimulus was just so huge over the last 12 months. There has to be a payback in demand to some degree. And I think part of the yields coming in is related to that there's going to be a deceleration that's bigger than what people are anticipating.
Hey, Mike, it's Brian Kelly. So, today we saw 10-year yields go below, or the dividend yield on the S&P 500 go below the 10-year yield. So you kind of had this shift there. In your world, is the bond market and yields going below 125? Is that over now? Are we looking at the other side? Have they priced in everything you're thinking about?
I think, Dan mentioned maybe we go to 1%. I think that would be probably the lower limit. But I think there's a point where lower yields are no longer good for valuations. And that's the part of the mid-cycle transition that's not over yet, right? So PEs are still elevated at 21.5 times forward. We think the right number is sort of 18 times. This is a tough game to play, but we have to play it. And we think that PE contraction will occur as yields go lower, meaning lower yields are no longer good for stocks because lower yields are telling us that there's going to be a growth disappointment. And we do think that there is some risk for earnings to come down in 2022 because of taxes going up and because of margin pressure, because of these cost pressures, which we do not think are transient. It's not runaway inflation, but these are more structural cost increases, we believe, that particularly in labor, that we think will translate into lower margins next year.
So, Mike, do you think the bond market and the move in the 10-year yield is actually telegraphing a message to the markets, or is it purely technical and something that you look through? Because I feel like a lot of people who are bullish on the markets in particular are saying, you know what, look through this. This is just a technical move. This is short covering, et cetera.
Well, it's both. I mean, clearly we got a little bit oversold, towards the end of March. There was a lot of technical things driving it that way. But, for the folks who think it's all technical, I mean, the move really began in April, which coincided with kind of this peak rate of change. So I think it's a little bit of both. I think the part that's being underestimated right now is that there is information still in the bond market, not as much as it used to be because it's somewhat manipulated. But there is information in the curve flattening, and the information is telling us, we think, that growth is going to be a little bit softer. That's why we think that index level correction is still in front of us. 10-15% would be quite healthy. We think that happens into the fall, and that will complete the mid-cycle transition.
Shepard Smith here. Thanks for watching CNBC on YouTube.